Bring in Leslie Picker for more on Goldman's quarter, and on second blush, that stock is actually ticked higher than on first blush, helping the Dow out.
Yeah, the market definitely reacting positively. It's a pretty large beat across the board here, just kind of digging through these numbers and comparing them with analyst estimates. Obviously a beat on both the top and bottom line. This is really a story about global markets for Goldman Sachs. They have a very strong FIC business, that's fixed income, currencies, and commodities trading. And that saw 55% gains year over year. That's largely driven to all of the volatility that we've seen in the fixed income markets, the commodity markets, even in the currency markets. That group did have some lower revenue in mortgage products. Obviously, you've seen rising interest rates. That's had an impact on some of the mortgage products, but huge beat in terms of analyst estimates. They reported $6.5 billion for this group. The street was expecting 5.6, so almost $1 billion more revenue just in that global markets group alone, which was 32% higher year over year, because equities also higher, although not as strong as that FIC group that I mentioned. Consumer and wealth management also saw a really big jump during the quarter, 25% higher than last year. Now, here were some of the offsets that led to that year-over-year earnings decline that we saw during the quarter. iBanking, investment banking, which we've seen across the board, 41% lower for Goldman Sachs, although that number did beat analyst estimates for the group. They say that corporate lending was actually significantly higher, primarily due to net gains from hedges related to relationship lending activities and higher net revenue from transaction banking, although that was partially offset by net markdowns on acquisition financing activities. That just largely has to do with overall market sentiment in the bond markets. Asset management, 79% lower, although that's a smaller business for Goldman. They did say that their provision for credit losses was about $667 million, compared with a benefit from $92 million last year. And this is kind of one of the key insights we have into their thinking on the macro right now, because they said that reflects both portfolio growth as well as macro concerns. There isn't much color in this release that I can tell in terms of kind of their thinking about the overall economy, although we should get a sense of that at 9:30 this morning when their conference call starts.
I don't know. It's starting to look like maybe those shares were on sale. If you look at that chart, Leslie, maybe they were on sale below 300. Time will tell, but you got the bluest of the blue chips down from, what, 410 to below 300. I mean, this market really hasn't adjusted enough to the realities of...
But here's the question. The question is, you have Goldman on one side. People are trying to figure out, you have Goldman on one end, and then you have JP Morgan on the other end. And what's really happening here? Right? Which is it?
That's right.
But book value is 301, right? Then it was down at 290.
Well, I think the issue that's plagued investors all year has been this idea of, okay, well, we get a benefit from rising interest rates, but then if the economy goes into a recession next year, do you have to then lower interest rates next year? Does that benefit go away? Oh, and by the way, you also have this double whammy of a recession. And so all of that has created kind of this almost like a tug of war effect in these stocks. And, we saw some really strong activity on Friday. Goldman seems to indicate that things could look better than people had feared, at least for now. But the really important aspect is, where do these CEOs see things going from here?